the subject of personal financial planning, we are having lecture series on insurance planning. In my last lecture on insurance planning, I discussed about the principles of insurance. Today I will start with the risk and why the insurance is important for all of us. What are the risks and uncertainties we do face in life, for which we have to manage the risk. And for managing the risk, insurance is an integral part. That through insurance, you can manage the uncertainties that comes in life. You can plan your finances so that in future you don't face lot of financial troubles because of those financial losses that occurs because of the risk and the uncertainties associated in life. And as the people are understanding the importance of risk, importance of insurance, the insurance sector in India is increasing at a very fast rate. It has become a large industry in India. If you see the size of the Indian insurance industry, it is almost $131 billion at present. Approximate figure, this is the approximate figure, right? Which comes to be 13,100 crore dollars. And if you if you convert it in terms of rupees, that is, you can multiply it with the present dollar rupee terms, as it means $1 is approximately equivalent to 82 rupees. So you can imagine the size of insurance sector in India. And this sector is growing at a rate of 17.1%. CAGR means compounded annual growth rate of this sector is 17.1% for the last 2 decades, which is a very phenomenal growth for any industry, because people are realizing the importance of insurance. In India, all financial planners, whenever you talk to any personal financial planner, they will first ask you what are your goals in life, and they will say that for achieving these goals, the first thing which you must do is take a proper insurance policy because of the risk associated in life, whether of your personal life or of your goods and the belongings which you own. So that is why the insurance is very, very important for any financial planning. What we mean by risk? The question is what we mean by risk. Risk is an essential concept in any discussion on insurance. In insurance, risk is defined as uncertainties concerning economic loss. Means all those uncertainties which we face in life, I'll be talking this in detail, right? There can be or there will be certain economic losses. So to bear those economic losses, we can have insurance so that we can mitigate those economic losses. Means in your life, anything can happen to you, any serious ailment can happen in life in your personal life or to your family members, right? For which you need money, right? You need money for hospitalization, you need money for medication, you need money for physiotherapy, any accident takes place, you need money for 3, 4, 5 months, 6 months, you may be bedridden. So when I'm using the word you, means any individual can be bedridden, and for that the person will not able to join the job, and for which there will be economic loss. So there are insurance policies these days that if a person remains unemployed for a period of time because of any accident, health insurance even covers that, right? Anything happens to your home, anything happens to in your business, if you are having a business, right? Any fire can take place, any loss of stock can take place, if any natural calamity can take place which will have an impact on your house. Means if there is a, say, earthquake, or if there is any natural calamity or peril that will damage your home, that will cost you a loss. So for that, all these things, you can have an insurance policy. In financial terms, in financial books or in finance terms, we define risk in terms of systematic risk and unsystematic risk. I'm not going into detail of that, but at this moment I'll say systematic risk is that risk which is impossible to avoid completely, means which affects everybody in a similar manner, like recession, inflation, war, right? So these risks cannot be avoided by diversification, but unsystematic risk which affects isolated group of companies or industries. But I'm not going to financial because my subject is here personal financial planning, so I'm not going to that, right? So I will come to the risk and losses that associated with the personal life or the individuals. So the situation regarding the loss will be unlimited and could go on and on. When I'm saying because of the risk, there can be unlimited losses that can take place. Because why I'm using the word unlimited? Because see, you cannot value a life. The life is not being valued. Any individual, the value of individual cannot be measured in money terms. But certainly that if any life is being lost, it will lead to financial troubles to the family members, right? So if you are properly insured, if the person's life is properly insured, the remaining members of the family can at least bear that economic aspect. Bear, when I'm using the word bear, means in the sense they can manage the financial requirement of the family if the individual's life is properly insured. So risk is an integral part of life. When you cannot afford to bear the risk personally, then you should definitely opt for insurance. When I'm saying that you cannot bear the loss personally, it means that it will be difficult. Nothing is impossible, but it will be difficult to bear the loss, economic loss that takes place because of that risk, because of the risk associated with that. So for that purpose, you must buy an insurance policy or you must have an insurance. We must design strategies for anticipating and dealing with potential risk. Such strategies includes risk avoidance. You try to avoid the risk, loss prevention and control, and risk assumptions and insurance. So how you can eliminate, minimize or transferring of the risk? Successful personal financial planning involves anticipating future events. See, if you are having a proper financial planning in your mind, you must anticipate what are the various risks associated in life. If you anticipate it, you will able to manage for it, you will be able to plan for it. So risk management is all about eliminating, minimizing and transferring the risk of all anticipated bad outcomes. If I put up in a few points that what are the risks associated, although it is very difficult to put it in few words or few lines that what are the risks associated, but broadly speaking, for an individual, the risk associated can be risk of life, disability, it can be illness, it can be ailment, means if any accident takes place, a car accident takes place and a person because of or bike accident takes place and a person becomes disabled. The person is not able to move or the hand doesn't work, or if you are working in a factory, anything happen to your physical body, right? So that will make the person disabled. Or the most uncertain thing in the world is the life of an individual. So anytime we think that only we are young, we are healthy, and it cannot happen to our life. But the God has made the life in such a manner that anything can happen in future. So the death is the most uncertain thing in the world. So death takes place means what will happen to the dependent children, what will happen to the spouse, how the spouse, if you are a single earning member, what will happen to how the children will study in schools, colleges, what will happen, how will have a life, you will have a proper standard of life in life which you was earlier used to, right? So these are the questions before us. There can be loss of property, damage, litigation. Sometimes the litigation can take place and for that you have to spend a very heavy money. It is not your intentional mistake or intentional error which you have earned in life, but because of any reason, any unforeseen litigation can take place that will create a lot of legal expenses and that can have an economic impact on your life. So all these risks we faces in life. For facing these risks, we can have a proper insurance planning. So these events can severely affect you, your family, or both by potential loss of income and liquidity. Means your income will be affected if you are become disabled, if an individual become disabled or is not able to earn or become unemployed, and then there will be a problem of liquidity also, because if you are spending a heavy money on the illness, on the hospitalization, so there will be a cash crunch. In means you have, everybody has a limited cash or bank balance, right? So if the heavy amount is being incurred on these things, there will be a problem of liquidity. So risk management thus serves as a way of limiting the negative consequences of such events. So what we can do is, we can have a insurance planning, and if any such event takes place in the life, to the extent of the insurance amount, that insurance amount will be borne by the insurance company with a small amount of premium. So in order to limit your risk, you can take sensible decision about your lifestyle. I mean, first thing is, try to avoid it. What we can do as an individual level, from the life point of view or from the health point of view, that we can change our lifestyle. When I use the word change in the lifestyle, what it means is, avoid high fat diet. I mean, do not mix up the drinking and the driving. If you are driving, wear safety belts and have a proper exercise. So this way you can avoid the risk. When you are buying a car, you must have a see to it that airbags are there. So if any accident takes place because of any reason, the airbags will protect your body. So that is the requirement. So however, given the inescapable nature of some risk like death, being the most apparent, risk management sometimes function more to reduce rather than eliminate harmful effects on life. And one common way of managing risk is to purchase insurance. Friends, as I have been saying here, that you cannot all the way eliminate risk in life. What you can do is, you can manage risk. And one way of managing the risk is buying an insurance policy. I'll be coming to that later on. Means when I'm saying buying an insurance policy, you purchase insurance for the life, for the health, for your belongings. For all these things, there are insurance companies, there are insurance policies where your amount for which you get insured is being protected. That is, the insurance company will bear that part of the money. So insurance, when you buy an insurance, you see to it that you are buying the insurance from the right company. When I am saying right company, it means the company which has a long financial standing, which is ready to pay for the losses that is being incurred to the extent of the insurance policy you have taken, right? Which does not mind in settling the claims, because if you get yourself insured with a company which is not customer friendly, where the rating is low, then that insurance company, you will not able to get the claim easily. So there will be a lot of hassles. So whenever you buy an insurance policy, see to it that you are buying the insurance policy or you are buying the insurance with the right company. So, and you definitely do not want to waste money paying for insurance that do not pay off if the need arises, because the insurer argues that your loss is not covered, right? So what it means is that whenever you buy the insurance policy, buy with the right and reputed companies which caters the requirement of the customers, which fulfills the mandate of the insurance policy. Means insurance policy highlights the details of all the conditions of the insurance, right? Means the terms and conditions are being laid down in the insurance policy. So it's a question of trust between the insurer and the insured, right? The insured is the person who gets the insurance, insurer is the company which is giving the insurance policy. You become, means when you are buying an insurance policy, become an informed consumer by doing your own research. So whenever you are buying an insurance policy, you do your own work. See, we normally say in the common language that when you buy vegetables, when you go to buy potato, tomato, even then you search for the market, But when you are buying an insurance policy, and if you're not making a proper homework, do your own research. Homework means do your own research. Which are the insurance company? What are the different pricing they are offering? What has been their track record? Right? To what extent what is their claim payment history? What is their customer service rating? Because in India at present, almost there are 58 insurance companies, right? And amongst the 58 insurance companies, approximately 7 are in the public sector and rest are in the private sector, right? So 58 is a large number. And as I was saying in the beginning of this lecture, that in India, the insurance sector is growing at a very fast rate, because the penetration rate in India of the insurance is still very, very small, right? Almost 4.1% of the population is covered by the insurance, right? Are taking the insurance policy or covered by the insurance. So there is a very huge scope of improvement in the improvement of insurance sector in the country. So if this expansion takes place, I'm sure many more companies will join this work of insurance, right? Will join this industry. And if you're looking for the company, if you're buying a insurance product, I will say use the word insurance policy, right? That you must see the credential of the company. So check out the quality of the companies and the type of insurance you feel you need before you contact any agent. Means different companies appoints different agent for having. You can have a online also. There are whole host of the online portals. Even all the insurance company have their own portals, and there are many companies, registered companies in India, which are providing the insurance, right? That is, they are registered with the various insurance company, and they provide a platform on which you can get an insurance. They will make the comparison of different companies, and you can have an insurance policy. And these insurance policies have different type of product as per your requirement. Means you can have a customized insurance policy. Customized means as per your own requirement. So you must check when you buy a policy, when you buy a personal policy, or if you are taking the help of your financial planner, because most of the high net worth individuals or most of the individuals who cannot make their own research, they take help of the financial planners. There are many registered financial planners in India, a very large number of financial planners in India. These SEBI registered, or if I talk in terms of the insurance regulatory is IRDAI, means Insurance Regulatory Development Authority of India. So those agents which are registered with IRDAI and the registered agents of the companies, right? You take guidance from them, and then you make your own research that which are the companies which are offering the product as per your requirement. When I'm using the word product means the policies. So you must check the quality of the insurance issues should be considered, include financial strength of the company, claims payment history, what has been their claim payment history, to what extent they have fulfilled their liability, what is their claim payment history, customer service rating, and competitive pricing. Because for the same insurance, different companies may be charging different amount. So for that, you have to see the pricing, that which company is offering what, which company is charging what amount for the same type of product or for the same type of policy. If you are buying, say for example, car insurance, right? So in the car insurance also, there are various facilities, various things that are there. So what you want. So as per your requirement, the insurance companies offers various type of policies. You will have to see that as per your requirement, which company is charging what price. What price means what policy amount, what premium you have to pay, right? So compare the pricing also, so that you can have same facilities at the lowest cost. So their pricing, their customer service rating, their claim payment history, the financial strength of the company, right? All these things you must check before buying an insurance policy. So how the insurance work, insurance planning mechanism of covering risk. Having adequate income protection and life insurance in place implies that your family will receive a helping hand right when they need it most. Means, if at all any financial requirement or financial help is needed at a time when any eventuality takes place for which you have taken an insurance policy, you must see that insurance company comes at your rescue, and you will be able to effectively pass on your wealth to your children, right? So if say for example, if an individual has taken an insurance policy of his life, in the age of 45 itself, if God forbid if something happens to that individual and the person dies, right, and that person is the only earning member in the family, then after that person, if the person is insured, is properly insured, when I'm using the word properly insured, means of the right amount. What many people do is that they take the insurance policy, but they do not take the insurance policy of a right amount. So you must take the insurance policy of such amount so that if anything happens in your life, in the individual's life, then for many, many years, say for example, if anything happens in the age of 45, 50, right? So for at least for 10, 15 or 20 years, your family doesn't faces any, or I'll say much financial troubles. Your family's basic requirement can be catered. So if I say, for example, if a person's annual income is 10 lakh rupees, so at least you should take a policy of 50 lakh rupees or 1 crore rupees, so that if anything happens to that individual for at least 5-10 years, that person's family can have that basic requirement fulfilled through the amount that the insurance company will give to the nominees of the insured, right? So this is basically basic broad formula for which you should go for the amount of the insurance. So why insurance companies are willing to take risk? Because you are paying a small premium and the insurance company is giving you a protection of a very large amount. You must have heard the word actuarial science. See what these actuarial science people do. They calculate the risk. Means that what are the potential, what is the probability of a person's death? If this much number of persons will take insurance policy, and what is the probability of the death, that during the tenure of the policy they will die, so that they will have to pay the full amount without payment of the full premium amount for number of years. So for that there is a actuarial science. What actuaries do is that they collect actuarial data. The risk of the loss suffered by the insured population is estimated by insurance companies. Insurance assess and price various risks to work out how much they would need to pay out if a policyholder suffered a loss for something covered by the policy. You have taken a car insurance, and if any accident takes place, the insurance company will have to pay to the amount of the damage of the car. Suppose I have got my car insured at 5 lakh rupees. If any theft takes place and I lost my car means because of the theft I lost my car, right? So to the extent of the policy amount, if the value of the car is 5 lakh rupees, the insurance company will have to pay 5 lakh rupees. But I'm paying a small premium of 3,000, 4,000, 5,000 rupees, approximate I'm saying. And against the payment of 4,000 rupees, the insurance company will give me 5 lakh rupees. But see, if an insurance company is making the car insurance of 1 lakh people, that car of all the people, of the 1 lakh people, is not going to be, there will not be theft of all the 1 lakh car, right? Or there will not be accident of all the 1 lakh car insured by the company. What is the probability of the theft? This they calculate. What is the probability of the accident? This they calculate. And the base of that, basically the policy premium amount which they collect, from that premium amount, if any loss is being happened to any individual, if suppose an accident takes place and the repair expenses of the accident of the car is say 1 lakh rupees. So insurance company will have to bear that 1 lakh rupees, right? So this way the premium collected is from 1 lakh people, and then supposing out of the 1 lakh, only 1,000, 2,000, 3,000, whatever the number may be, right, accidents takes place in a year. Of that, those 1,000 accidents or 2,000 accidents that take place, they will have to compensate, or they will have to bear the cost of repair of those cars. So premium collected is from 1 lakh car, accident took place of the 1,000 car, and the expenses borne by the insurance company will be certainly less than the policy amount. By and large, in this way, these policy or these insurance company works. So this helps the insurer determine the premium. Insurer means the company which is giving the insurance. So insurer determine the premium to be charged for insurance. The premium collected from the pool of policy holders is invested, which enables them to make profit in the business. As I was saying, suppose 1 lakh people are getting their car insured. So the premium will be collected from the 1 lakh people, 1 lakh persons who have got their car insured. And with this premium, the pool of money that is being collected by the insurance company, wherever the loss is being suffered by the insured, the person who is getting the insurance, that loss is being compensated by the insurance company. Certainly, normally the practice is that this loss compensated by the company will be less than the amount collected by the premium amount. So how insurance works? An insurance policy is a legal contract that binds both policyholders and the insurance company towards each other. Means there is a policy determines the terms and conditions of the insurance. It consists of all the details of the conditions or situations under which either the insured individual or policy nominee receive the insurance benefits from the insurers. So friends, I'll be continuing this lecture in my next lecture on the insurance planning, right? So what it means is that any financial planner, or for your financial planning, you must get insurance for the management of risk. Ultimate thing is how to manage risk. Because when we talk of the financial planning, in the financial planning, the plan is made in such a manner that in future, if any financial trouble arises or if any major expenses arises, that major expenses can be easily borne by the person. So for this, insurance is one important aspect of financial planning. So I will continue with this insurance planning in my next lecture. Thank you.